My name is Jonny Haycock, partner at Greyerz, and I thought it would be worth putting the 25% correction that we've seen in the gold price into some form of longer term and shorter term perspective. Certainly, the 25% correction that we've seen from the January peak in gold is a useful reminder that even in the strongest structural stories, they don't move in a straight line. These secular bull markets have pullbacks. That is the nature of the beast. And so I do think that some context is important. It is worth remembering that in 2025, gold was up 65%, one of its strongest years in decades. In the last 5 years, gold is up 128%. And if you think that we are in an inflationary environment, a stagflationary environment, then the last great bull market that benefited in that environment was, of course, the 1970s. And in the 1970s, there were 5 drawdowns of over 20%. And indeed, between 1974 and 1976, gold halved before rallying sevenfold and peaking in 1980 at around $850 an ounce. So the context is important to remind ourselves that whatever the asset class, all bull markets get tested. But it is our view that the case for gold remains as strong as ever. Gold suffered in the near term from a couple of headwinds. 1, a stronger dollar, and 2, higher real rates. Interestingly, higher real rates tend to coincide with peaks in stock markets. Year 2000 is a very relevant example where high real rates at that point heralded and timed with the bursting of the tech bubble. I don't think it's a stretch to say that we've got a tech bubble in stock markets today. The concentration is higher than we've ever seen. So maybe that should be a warning. We should also remember that central banks, despite this correction, are buying the dip. Of course, we know that there have been some examples of 1 or 2 central banks that have been forced to sell gold for liquidity reasons during the Iran war. However, do note that central banks now hold more gold today than they do US treasuries. Inflation is sticky. Currency debasement remains inevitable as government debt is out of control. So I want to take perhaps an even bigger picture view by looking at gold relative to government debt and relative to stock markets, just to illustrate how deeply undervalued gold looks versus those two asset classes. So just focusing on the first chart here, which shows the value of US gold reserves as a percentage of government debt. What you can see is if we look back to the last period of great expansion of debt in the US in the Second World War, at that point, 51% of federal debt was backed by gold. Roll forward to today, where the debt is even bigger, and you have only 2.8% of federal debt backed by gold today. That is an unbelievably low number given the level of federal debt that we can see in the US today at touching $40 trillion. And just going back to 1980, what you can see there is that 18% of federal debt was backed by gold at that point. And if we were to get back to the 1980 levels, then that would imply a gold price of $26,000 an ounce. You don't even have to think about the arithmetic of if we were to go back to World War II levels, where if 51% of the debt was backed by gold today, you would be looking at $75,000 an ounce. Clearly, that number seems crazy, but at 2.8% today, hopefully this just gives you an example of how deeply undervalued gold is today relative to the explosion in the debt. And then just take the second chart, which is looking at gold versus stock markets. So what this chart shows is the value of all above ground gold divided by the global equity market cap. And what you can see here is that that number today, gold as a percentage of equity market cap, is around 18%. Go back over the last 120 years, and that average is around 40%. So today, looking at gold versus the value of all gold above ground versus equity market cap, we're probably half where we should be just to get back to the mean, which would imply $9,000, $10,000 an ounce at a minimum. So whilst of course we have to be respectful of near-term corrections, what I want to show here is that they are totally normal in the context of secular bull markets. It was the case in the 1970s. It happened on 5 occasions of greater than 20% drawdowns. And in fact, as I said, gold halved between 74 and 76 before sailing on to rise 7-fold to the peak in 1980. And we see absolutely no reason today to suggest that the fundamentals have changed one bit. History shows us that when any country gets as indebted as the US is today, as the UK is today, as France is today, and as Japan is today, history shows us a very straightforward point. Governments have no choice but to print money to cap yields because they cannot afford higher rates. They will save the bond market at the expense of the currency, and that is what we expect to happen going forward. But please, please remember, it's not just about the gold price going up. It is what is inevitable to happen to fiat currencies as governments are over their skis and have to print money to inflate away their debt. Thank you very much.